Here's something to get you excited. Do you know that mid-cap stocks actually deliver a rate of return higher than not just large caps, but also small cap stocks in most of the years? So, if you exclude the last 2-3 years where small caps and micro caps have gone through the roof, in any of the years, when you look back at a rolling 5-year or 10-year basis, you'll realize mid-cap stocks have actually outperformed both large caps and small cap stocks. So right now, if you talk about mid-caps, they've fallen about 20% from their peak on average. Mid-cap index, look at how much it's fallen from its peak. A lot of mid-caps have fallen more than 20% from their peak. And today, I'm going to talk about 5 mid-cap stocks which have fallen 20, 30, 40, and in one case at least almost 50% from its peak. And these are the stocks which I believe we should buy right now, because at some point they will bounce back. Their businesses remain intact. They're very, very good stocks. And in fact, why they've fallen so much in most of the cases is either on account of valuation, which is that they were trading at an extremely high valuation. And at some point, this correction had to happen. In fact, in a couple of these cases, I will talk about stocks which I liked and I previously said don't buy them at these prices. You'll get a better time to buy these stocks, and right now is that time. So let's get right into it. So the first stock that I want to recommend today is Neogen Chemicals. It's a relatively small company with a market cap of about 3,800 crores. The stock is currently trading at 1,440 rupees. Now this company is in specialty chemicals with a focus on bromine and lithium based chemicals. End use for their products is in various industries including pharmaceuticals, electronics, engineering, and most importantly the area where I am really excited about is electric vehicles battery manufacturing. Now why I like this company is, despite its high price to earnings multiple, if you look at it today, it's got a net profit of about 780 crores and its price to earnings multiple is about 110, 115, which is extremely high. And also the company has a relatively high debt. The debt to equity ratio is about 0.5, which is, not negligible. It's quite a bit. Price to book is about 5. So fundamentally, and optically, if you look at it, this company may appear to be slightly expensive and nothing to get excited about. But I'll tell you why I like this company. This company is very futuristic, and what they're doing, which is different from a lot of the other companies which are trying to get into EV battery manufacturing, is that they're actually manufacturing the ingredients which go into EV battery manufacturing. So they'll provide salts which go into making lithium ion batteries. So, if you look at a lot of the companies right now, whether it's Amara Raja or Exide, which are setting up plants in Karnataka and Tamil Nadu, or you look at Reliance, which is setting up a plant in Gujarat for manufacturing of EV batteries, or Ola Electric, which God knows is setting up plant where, but so far, nothing is very clear. This is a company which has a history of importing, through long-term agreements, lithium salts, which, they have 34 years of experience of importing into India. To give you a stat, 50% of the total lithium imports into India right now are done by Neogen Chemicals. And they've got into a tie-up with Mitsubishi, and they're gonna start exploring lithium within India. There are sites where we've discovered lithium in Jammu and Kashmir, in Chhattisgarh, in various other places. So they're doing both. They will be importing lithium to supply to in fact, they've already set up a plant from where they're supplying on test basis their lithium salts to a lot of foreign players and original equipment manufacturers in India. So basically what I like about this company is this is the only company which will be a supplier to a lot of the other EV battery makers. So unique in its way. The EV market is set to grow by 12 to 15% by conservative estimates by 2030. Some aggressive estimates say that it could grow up to 30%. So this is not something that I'm recommending to hold for 1 or 2 years. So as I said, Neogen right now is importing chemicals for, supply of lithium salts to battery manufacturers. But as the technology scales, they have plans to, use their own technology to extract the chemicals from Jammu and Kashmir, Chhattisgarh, and other states where it's available. So if my personal estimate is, if things go right and as per their plans, then they can generate a revenue of about 2,500 to 2,800 crore over the next 5 to 7 years from this business. Again, what stands out for me for this company is It's right now not just talking about it or taking concrete steps, it's already out there importing 50% of the lithium ion chemicals and has already started supplying test batches to OEMs and overseas players. So this is a very exciting company. You should watch out for this, and if you get this company at a cheaper valuation, buy it, keep gradually adding into this company, because this is a long-term play. I wouldn't recommend somebody to lap up on this and add everything on day one, but keep this on your radar. Natco Pharma, and currently the stock is trading at a price to earnings multiple of 8.8, which may appear very cheap given that its 10-year historic price to earnings multiple is about 28.8. But you have to understand why it's trading at such cheap valuations. There's of course a reason for the stock to trade where it is trading. It's not just because of the tariff wars between, or rather I should say Trump's tariffs plan of 25% or whatever it settles at on Indian pharma companies. Keep in mind that Natco Pharma gets about 73% of its revenue, and these are estimates. They don't disclose this number, but based on various analyst reports, these are estimates. They get about 73% of its revenue from US alone. And that's not the only thing. Why the company's stock price has fallen so much is because one of their main drug, which is Revlimid, which is the cancer drug, is going off patent. So about 78% of its total revenue, which they get from the United States, comes from this one single drug. And this drug is going off patent very soon. And once this goes off patent, they will have about a 70-75% hit to their revenue is what is expected. So there's a reason why the stock is trading at the price at which it's trading. But why I'm positive on this company is, first, because this company has very good cash reserves of about 3,500 crores. They have no debt on their books, and they've had a history of coming up with drugs which have about 180 days of exclusive marketing rights in the US. And I'll explain how they do that. They've done that with Tamiflu a few years ago. So basically they rely heavily on Hatch-Waxman Act, which is a US law designated to balance conflicting forces in the pharma world, which is innovation and affordability. So how it all works is, innovator companies are granted up to 20 years of patent protection. And this is the time for which they're the only ones who can sell the drug that they make, basically to recover their R&D investments. And thereafter, under the Hatch-Waxman framework, generic players like Natco can file an abbreviated new drug application, which is under the para 4 filing. It's a little complicated. Now, if the generic challenger is successful, then on the expiry of the main core patent molecule, they get 180 days to sell their generic drug instead of the original drug which got the patent. So the core of Natco's strategy is to be first to file for high value molecules, and be successful in your FTF filings, and then get the exclusive 180-day period where you can sell your drug after the main drug goes off patent. Right now they filed, there's about 16 odd drugs which are in the pipeline for which they filed this. And primarily semaglutide, which is going off patent right now in the US. The company that sells it has a patent for at least until 2031. But Natco has filed its FTF for that, and if successful, they'll get a period where they will be the only ones who would be able to sell that. But in addition to that, there's a lot of other drugs for which they've filed FTF. Now, the reason why I'm really positive on Natco Pharma is that they've got a history of doing this. They came up with Tamiflu in 2017, then Revlimid in 2022, and right now they're in a much better financial position in terms of the cash reserves that they have. Debt-free company with 3,500 crore of cash reserves. They've done a few FTF filings. They've got a track record of doing this in past, and they're tying up with a lot of foreign companies along with whom they want to do these FTF filings. So personally, I feel the stock should not have fallen to the multiples to which it has fallen. I think it could be a combined effect of Trump's tariff plans and Revlimid going off patent. But right now is a good time at 930, 940 levels to add this stock and keep it in your portfolio. I have no reason not to believe that it should not grow at least 15 to 20% year on year for the next 5-7 years. So the third stock that I'd recommend you to add or look at for your portfolio is Indian Renewable Energy Authority. It's a government-owned company. 71.4% is owned by the government of India, and it's essentially into power financing. But unlike traditional power financing companies, it has two distinct advantages. First, it does not have any legacy issues of being invested or having given out loans to thermal or state power generation companies. So it's a fairly clean company in terms of where they've given out their loans. So their top 10 or top 15 clients, while they don't disclose that, but from analyst disclosures we can sense that their top 10, top 20 clients include the likes of a lot of state power generation companies, particularly in the south, like Tamil Nadu Genco, Northern Telangana, Karnataka Power Generation, and a lot of government companies take financing from here, like SJV and Green Energy. In private players, Adani Green and Adani Solar, Renew, a lot of these companies are using IRDA for their financing needs. So it is a pure play in terms of extending loans only to green energy companies. Now I know this is a high risk area, and right now IRDA has a very high interest coverage as well. Be that as it may, I think this is the fastest growing segment of financing, and renewable energy is the fastest growing segments within energy when you compare it with thermal, nuclear. So I'm pretty positive that going forward this is a need. It's expected to grow at 20 to 24%. This is a unique company because it's one of its kind. It did its IPO late in 2023. It so far does not have any bad debts on its books. I know it's a very risky segment to be in terms of companies not doing well, but you have to believe that some companies in this segment over the next 10 years have to do well. So instead of betting on the companies which are into power generation and solar hydro space, I am more positive on companies financing companies which are into power generation, and IRDA is one of those companies. In fact, it's the largest company in India which does that. So it's a pure power generation company. Some of the things that are working in its favor is that recently the government allowed 54 EC bond, which is the capital gain bond, which so far people were doing in NHAI and PFC and Indian Railway bonds. Now people can invest in IRDA as well. This is as early or as late as July 2025. So they'll now get access to a very low cost capital, and they can use that to finance a lot of projects going forward. So currently the stock is trading at about 146, which gives it a valuation multiple of about 25 and a half, which is below its past 2 years price to earnings multiple, which was about 34, 35. So it's trading at not a steep discount, but at a reasonable discount. You may want to wait and buy it on dips, but given the way markets have fallen, I think it's already available at an attractive valuation. So this is another stock that you should consider adding to your portfolio. So the fourth stock that I want to recommend today is a stock which I have actually advised against buying when it did its IPO, but I've recommended recently on a TV show as well, is Tata Technologies. And I'll tell you why I'm recommending it now and why I said don't buy it when it did its IPO. It's an engineering and research company, and it's got really marquee clients. I mean, their own clients, which is Jaguar and Land Rover and Tata Motors, is their big clients for the company. In addition, they provide engineering services to, Airbus, and the potential and possibilities for this sector are amazing, from, home automation, which is the future, to, driverless cars and all sorts of technological advancements. They do R&D and provide EPC solutions to a lot of these companies. And why I didn't like the company when it got listed was because I said after whatever the price band, market was in such a frenzy at that time, about 2 years back when it did its IPO, that the stock had to keep hitting upper circuits post its IPO, and that's exactly what happened. I have that research which I published a few days before the IPO, where I said I expect the stock to actually hit upper circuits and reach about 1048, 1050 odd levels. It actually went up to 1200 within 2 days, the third day of its IPO. And at that time the stock was trading at a price to earning multiple of about 80, which when you compared it to its competitors KPIT and Tata Elxsi, which is another Tata company itself, is one of its competitors. So when you compared it with its competitors at that time, the stock looked still expensive in that market. And I said it's a great company with a very good future, but I'd buy it at half the valuation at which it's trading today. Today at 680, 685, it's available exactly at half the valuation at which it was trading that time. So, the stock has fallen almost 50% from its peak. So, that also explains how crazy IPO frenzy is. And, some of the IPOs that are going to hit the market this year as well will unnecessarily trade high, and you should wait to buy them at a cheaper price. Be that as it may, for this company, the price at which it is trading today is actually a great price to add it to your portfolio. So Tata Technologies is one stock you should definitely add to your portfolio at this price. Don't wait for it to fall any further. I can with fair amount of certainty say that the businesses who fund this company, which is Tata Motors, Jaguar Land Rover, Airbus, or any of these overseas companies, are all very deep-pocketed clients. And as the economy evolves, as newer technologies come about, the revenue for this company will grow at least 20 to 24% year on year for the next many years. So this is definitely one stock you should add to your portfolio. And the fifth and final stock that I want to recommend is Can Fin Homes. And there's three reasons why I've selected this stock from within the financial services space. First is the interest rate cuts of RBI. So you see, if you look at it from 2022, where repo rate was about 6.25%, the interest rates have been consistently falling over the last 2.5 years or so. Right now, the repo rate is about 5.5%, which is set to go down even more. Now, low interest rates are the biggest impetus which a housing finance company can get, because that leads to higher loan offtake. Can Fin Homes in particular operates in affordable housing segment, particularly in South India. So if you see its geographic split, it's got 65% loan book in South India and about 35% in North India, where it's expanding. It's backed by Canara Bank, so it's got a very good legacy. Now, low interest rates will play out over the next 3 to 4 years is my sense. So right now, this stock is available at very, very good price to earnings multiple, which is my second reason to buy into this stock. It's available at about 11.2, 11.3, which is a good 20-30% discount from its historic averages. Keep in mind, if you look at other housing finance companies in the sector, you will find companies which are available at even cheaper valuations, like the likes of Repco Home Finance, which is a Tamil Nadu very concentrated state where it has its loan book concentrated. It's available at price to earnings multiple of about 5.5. Same goes for PNB Housing and LIC Housing. PNB Housing did its IPO about 2 years back or so. So these companies are all available at price to earnings multiple of below 6. But what stands out for Can Fin Homes is that it's got an 18% growth rate of its loan book year on year for many years. It's right now not only geographically well diversified, but also has very good NPA ratio compared to its peers. So in terms of operational efficiency, it is better than its peers. And the third reason is, housing finance companies, which were at one point, flavor of the month kind of sector in about 2016-17, if I remember correctly, is right now completely out of flavor, because there's too many companies in housing finance. If you have a look at a chart of the number of companies in housing finance sector, there's about 14-15 odd companies which are all in the listed space. But be that as it may, I think going forward, one or two of these companies have to do well. India remains a very under-housed country. A house is one of the most aspirational things for the middle class and even the lower class in India. This company has its focus on affordable housing segment. So from this price, if you add this stock, I am pretty confident that in the next 5-7 years, it will be a very good compounder. So Can Fin Homes is a stock from the mid-cap space you should definitely add in this fall.